Hello, everybody, and welcome to today's Investor Insights, Online Investor Insights. I'm Donnie Halper. I write the weekly Startup One Stop newsletter, and we host these events every 2 weeks, different guests each time. And I also work with founders, helping them with their pitch decks, because you all need help with your pitch decks. You never know how to do them. And then make introductions to investors where and when appropriate. And I want to thank Joseph Katz for hosting us. Joseph, tell us about what you do.
Thank you, Bonnie. Good morning, everyone. Thanks for joining. I'm a results-driven marketer. I've worked in both corporate America and early stage companies. So I've seen the good, the bad, and the ugly of marketing and growth. Biggest, most impressive success company that I worked with was I joined the company early, ultimately had a $100 million exit, and got to experience that whole wild ride. And now, in addition to marketing, I am, as we were just talking about, doing my part to spread good news and education around the situation in the Middle East and fighting anti-Semitism. So that's my passion project. Good to be here. Thanks for joining.
So for the first time, we have two guests. We have Joe Milam from Angelspan, and we have Glenn Argenbright from Quake Capital. So who wants to introduce? Well, G comes before J, so Glenn, why don't you take it away?
Sure. So first of all, super excited about this. Bonnie, I never jot down notes. I always just, and that's a terrible admission, but for these types of things, I'm usually just off the cuff. But I'm very passionate about some of the things we're going to talk about, and I've been very excited about this. And also just getting on with Joe, I just riff really well together. In terms of background, I've been doing startups for about 30 years, 25, 30 years, most of that time as a founder. So I, over about a 25-year career, founded 14 of them, did some additional turnaround work for some hedge funds, some of the biggest hedge funds in the world. But of the 14 startups I did, I was pretty good at exiting companies. So I had 9 exits and I had 3 public offerings. The first big IPO I had was with Lehman. Well, there's a lot of people on here I can tell are old enough to know who that is. And it was about a $4.5 billion IPO, which, you tell kids that now when you're working with startups, they don't even think they think that's good, but they don't realize that that's like a $45 billion IPO today or whatever. Yes. So you don't get any street credit for that, amazingly. But that sort of shaped some of my career, because then I formed a family office and started working with other families. And so the fund that I run now largely was designed as something that I was going to do with a bunch of other friends and families, and kind of focusing on things families like and are pay attention to. Through that, we've done about 280 investments. And then I personally have about 110 additional investments. So I don't almost do anything other than startups. I'm a horrible family office. I barely do any real estate. I barely do any infrastructure. All I do is venture through my family office and my fund. So that's me, venture guy through and through.
Startup guy, Joe.
Yeah, I'll certainly echo what Glenn said. This is going to be fun. I come at it from the investment side. I probably could have run a hedge fund in college if I knew what a hedge fund was in college, but I just had game in the stock market and had people giving me money, and migrated to E.F. Hutton right out of college and found that's more of a sales business than it was a real finance business. So I got lucky and joined a multifamily office there at 3000 Sand Hill in 1990. And that firm had recently been purchased by a European bank in Liechtenstein, because that firm and my predecessor was the boutique money manager. And when I stepped into that business, the first portfolio I was handed to manage was Larry Cincini's personal money of Wilson Cincini. A couple Sequoia partners, Pierre Lamond, who was the first chairman of Cisco, and Sven Simonson were clients of ours, and I managed their charitable remainder trusts. Senior executives at Silicon Valley Bank, et cetera, et cetera, et cetera. And then my boss died of cancer, and I took over the business, actually. He died in 92. I bought it from the bank in 93. And then a year later, the internet commercializes and all hell breaks loose right under my nose. And the earliest angel group that many of you may be familiar with, the Band of Angels, was founded in my office by my subtenant, Hans Severance, who, if you're familiar with the Angel Capital Association, the Angel of the Year Award is called the Hans Severance Award. because he was the founder of Band of Angels, and he was dating one of our clients, and that's how he became a subtenant. So I mean, I just had these series of what I call Forrest Gump-like experiences that just shit happened right on my nose because I was in the right place at the right time. And I got active. I was an early member of Band of Angels, and then an angel group sprung out of eBay. They had 3 deals pitching their venture arm every 2 weeks, and a guy that was on their venture committee, Gary Dillabo, said, "Wait a second, there's a bunch." They had already had their IPO, and they said, "You formed an angel group to have those deals come pitch some of the, the eBay employees that had money in their pockets in the evening time while they traveled on the day they traveled to pitch the venture arm." And they opened that up to non-eBay employees, and I was the 9th member, the second non-eBay employee, and that grew to 120 people strong, seeing 3 deals every 2 weeks that had already been vetted by eBay's venture arm. So I just got thrust into that, and I experienced how the venture process is starkly contrasts to how we manage money. We did our own securities research. We picked our own stocks, and we didn't talk to management. We didn't talk to Wall Street analysts. We had data. We built portfolios, and we were quite good at it. For 13 years, I was actually the top performing large cap core manager in the United States based on absolute and risk adjusted returns. Because even though I wasn't a stock picker, we picked stocks. I didn't think of myself as a stock picker. I architected and engineered a process to use data to build portfolios to capture the potential alpha, but most importantly, manage risk. And it's from that background and the experience and exposure to the venture that I've now migrated to building a platform to bring the same level of investment process rigor to the private markets, so that you could actually treat it like a real asset class versus a gambling casino. And you could actually isolate the beta of the asset class around the venture thesis and capture appropriate alpha by managing risk properly. So.
Oh, thank you. So we'll go around the room and everyone will very briefly introduce him or herself, because I want to hear about all the crap you wish you knew. That should be fun. Dr. Daniel Sanders.
Hi. Well, I was here last meeting, but let me just discuss and tell everybody about myself who wasn't there. I'm founder and CEO of Ultra Oral Ltd, based in Israel. It's my 3rd company. We're very focused on putting out products for the health conscious consumer. First 2 product offerings are going to be for treating periodontal disease, and also for treating to prevent Alzheimer's, dementia. I'm a dentist, as you can tell when I say periodontal disease. So I'm a dentist from New York originally. Had a practice there for many years in Manhattan, Midtown, and moved here to Israel about 20 years ago and got into the startup environment here in Israel, and been working on that now since then. And very excited about the current company. We're actually developing a universal platform to allow greater bioavailability. We can put anything we want and get it through the oral tissues, which is a tremendous way of doing things. You don't have to worry about having drugs, get knocked out through the GI tract. And
we have to keep introductions short because we have a lot of
liver things. So that's it. That's enough on me.
Okay, thank you. Leah. Oh, okay, Sam.
Hi, and nice to see Glenn. And sorry, my video's not on. I'm driving as usual at this time of day. But anyway, Glenn is actually through Quake is an investor in my company, Axel AI. We're based in Boston, and it's about a 20-person company. We apply AI to searching and curating large amounts of video.
Thank you. Great.
Hey there, Bonnie. It's Craig Bromberg. I'm CEO of Homesy. Homesy is a social home discovery network. In many respects, it's the perfect response to the Department of Justice successful guilty verdict last week or 2 weeks ago in Kansas City. We really have created an entire platform that allows consumers to build profiles of their homes. They're not listings. And as a result, create a completely new source of data which is room focused as opposed to location focused. And we compile that on a blockchain that you don't even know it exists. It's just, it's called a home NFT, and you get an account and you get points for it, and those are redeemable through a CRM. It's homesy.us.
Thank you. Feel free to put in the chat too. David. David?
Bonnie.
Oh.
Can you see me? Bonnie?
Now I can see you, yes. I don't think your sound is working.
Hi, Bonnie.
Yeah.
Oh, so sorry. Can you hear me now?
Yes.
Okay. Hi. David Littauer, New York. For Discount Dojo. I work which is a market research firm based in New York.
Okay, thank you. Lance.
Let me see. Hold on.
We can come back to you.
Hello, can you hear me?
Yes.
Oh, yeah. Hey, how you doing? I'm iOS and Android developer from New York, and I launched several apps as startups. None of them went anywhere, so I'm launching a new one now.
I saw that in the chat. Thank you. Ken.
Good morning, Ken Deering, CEO of iGuard Home Solutions. So we have two areas. We have our age tech solution that allows older adults to safely continue cooking even when they're impacted by cognitive memory issues. And also we are over in the SureTech marketplace as a predict and prevent solution for personal and commercial property and casualty insurers.
Thank you. Allison.
Hi, I'm Allison. I'm the founder of Consume, which is an education information platform through video for cannabis, actually. So I am currently in Florida, but spent 10 years in New York City and the past 2 in Denver, where I met Joseph's son. So that's how I got here. But nice to be here.
Oh, thank you for being here. Andrea, and tell us where you are today since you're always traveling.
Morning, everyone. I'm in the Bay Area at the moment. And I'm a reformed attorney and have been working for a Hong Kong family for the last 5 years, focusing on U.S. tech investment opportunities.
Thank you.
Sure.
Charlie.
Hey everyone, I'm Charlie, based in London, co-founder of a startup called Spot. So it's essentially, in the UK, we don't have Venmo, Cash App, Zelle, or Apple Cash. So you still have to put in people's bank account details when you want to send them money. So Spot will allow for basically payments via WhatsApp and iMessage. So we've just got our license approved from the UK and the EU. So we're going live in a few weeks, and we're just finishing our pre-seed round at the moment.
Oh, congratulations and good for you. Bharat, good to see you almost.
Yeah, thank you. I'm driving. My name is Bharat Ramani. So I work with startups which are developing solutions to improve the quality of life for neurodiverse community. So we work both in the US and the India corridor, and 2% of the world's population is neurodiverse. So my focus is to see how we can improve the quality of life for them. Thank you.
Yes. Ian.
Thanks, Bonnie. Ian Garmez. I'm in Toronto. I'm COO of a virtual film school. We are an online school for content creators, currently doing most of our business in Asia, but soon in the US. Thanks.
Jonathan.
Hi, this is John Landers with iGuard. I'm there. Actually, I'm in Tampa, Florida today. And I work with Ken as the CMO of the company. And my background is in consumer packaged goods and lifestyle marketing.
Oh, thank you. Joseph Chan, always good to see you. How are you feeling? Oh, you're muted right now. Oh, we can come back to. Oh. Sorry, the names keep jumping around, so apologies. Did I miss anybody? Oh, Sandra Connor.
Thank you for being consistent, Bonnie. It's still Sandra.
Sandra! I do that every time. I'm pretty sure it happened.
Yeah, this is our running joke. Love Bonnie too.
It is.
All right. My name is Sandra Connor. I'm in Indianapolis, Indiana, serving the English-speaking world with marketing. We help you to tame the marketing monster so that you can build sales with momentum faster and easier.
I know I missed Tara. Oh, Tina.
Hey, nice to be here again. Nice to see everyone. My name's Tino Go. I'm the CEO and founder of Baru. Yeah, Baru is a gig platform for underused manufacturing automation. We sell kitchen cabinets with a Vistaprint like front end, and we send the machine instructions and the materials to a manufacturer. So both sides, the customer gets a lower price and the manufacturer gets a higher margin. I'm now in Dallas. I just finished the Code Launch finalist event, where we were the top 3 of the, I don't know, 146, whatever. And so that was a ton of fun, really well produced entertainment, venturetainment as they call it. But we already have some dealer interest, so I'm going to spend the next 2 days vetting that out and the subsequent VC interest that spawned from the event too.
No,
So in Dallas, if anyone's in Dallas, or I'm happy to spend next week in Austin, anyone's in Austin.
Woo! Yes, please.
Yeah, good for you. Tara.
Hi, my name is Tara Tedros Whitehill. I'm a photojournalist and visual storyteller, and I have a media agency where we help entrepreneurs and social impact organizations tell their stories better through consulting and workshops. And I'm keen to listen to all the stories of everyone here and how, you're supporting them. So thanks.
No, thank you. Deborah.
Hi, everyone. I'm Deborah Lee, and I just joined, so I apologize. I am a business partner with Bonnie. We have a business debonair consulting where we work with founders to prepare them for funding. So we help with your pitch decks, executive summaries, and we introduce you to our network of investors, and we coach you individually for each investor that we set up a meeting with. So that is us. And you know where to reach Bonnie. And if you'd like, we can drop in our information in the chat. Thanks.
I will endorse that they do a good job at it.
Oh, thank you. And I can tell you, Joseph is probably multitasking. Joseph is an investor as well. So, guys, take it away. Tell us, excuse me?
Hold on a sec, man.
Oh, he's content.
Hey, hello. What did you need from me, Barney?
Oh, just give us a little bit about who you are. That's
Sorry, I'm on a call, but quickly, New York-based early stage tech investor, seed to Series A, B2B North America.
Thank you. Very succinct. So, guys, tell us about all the crap you learned that you wish you'd done before.
Well, Joe kicked off with something I think that he and I share that I think is a good place to start. Maybe not in the shit we've learned, but in the kind of our approach that'll define some differences. So we're very data oriented, both of us. My background, most of the deals I did was in data science, so I have a definite background. I'm also a reformed lawyer, but I never really practiced. I launched a business while in law school, and that was a data oriented business. And then my first company was a big ad tech company, and so that was all data. And so I kind of came up that way technically. And then, talking to Joe separately, I know that I think you've even joked, Joe, about not even needing to meet the managers. And you kind of alluded to it a little bit, right? It's like, and it's really funny, when I was forming Quake, so much of our thesis was on traction and merit, metrics, basically, not the merit of the conversation that we have with the founder. And that's, when you look at our portfolio, we have massive levels of diversity in our portfolio. 10 times more female founders, 10 times more Black founders, 6 times more Hispanic founders. And a big part of that is because it's data. Like, we were just looking at the traction. So it's really fascinating when you look at that. Anyways, I wanted to highlight that because I knew that Joe kind of alluded to that, and we share that in our approach. So everything we talk about will probably be a little bit contrarian in that regard, because even though, we work with my fund works with like 650, 700 founders. I don't even know the numbers anymore well, I do. We actually track all that data. I just don't remember it. While we work with all those founders, we have great relationships with all those founders. That's really not a huge part. And Sam could tell you this is not a huge part of our thesis as we're interviewing teams. It's a lot more about what you've done. Anyway, Joe, I don't know if you want to say anything on that, but where I want to kick off after we get through that is I don't want to talk a little bit about some of the stupid advice and I'm really thrilled there's not too many VCs, so I won't piss off too many people. And I know, Joe, you're not as worried about pissing people off, maybe. You're quite happy to do it. So am I guess, but I still have to go to the conferences every so often. So I'm curious how many people I'll piss off, but I do want to talk about some of the dumb advice that VCs give to founders. And it's not really dumb in their perspective. So that's what I want to talk about today.
If you want to kick off, I mean, yeah, we could riff for, longer we have here on the issue of data. We have our own office hours every other Friday. And we had a data scientist, smart guy, on there a couple of weeks ago. And he and I were riffing about this issue of data. And the reality is, again, having been a money manager, there is no shortage of data managing money in the public markets. Bloomberg made sure of that, and there's tons of data vendors. So there's no shortage of data, but you still have a lot of miserable performance coming from public money managers. And the important thing, the equation of using data to take out the noise, find the signal, to find the information that's relevant. But then equally as important, that information has to be in the right hands, people that actually know what to do with the data. So that becomes actionable insights. So data, information, actionable insights. And if you look at the research from Danny Kahneman, the father of the Moneyball concept, more data actually leads to worse outcomes when you think of investment or decision-making processes, not just investments. This is any sort of decision-making process. And the optimal amount of data to have access to make an efficient decision, where the collection of your decisions, your portfolio of decisions, if you will, are optimized, the outcomes are optimized, is 4 data points. That elicits the information you need. The magic is knowing what's the right 4. And that's where I see, and I've seen this, for 30 years, as has Glenn, that so many people in the venture industry that have control over their LP's money, they have no idea what they're doing because they've never invested money before. They worked at Google or Facebook or whatever else, and they could scrape together some of their buddies' money after an IPO and call themselves a VC. The venture industry itself is not a profession. There is no training requirements. There's no certification. Hairdressers have more professional rigor they have to adhere to become a licensed beautician. And that is profound because there literally is no professional standards. There's no standardized performance calculations. So an LP can actually make an apples to apples comparison on, is this a good VC? Is it talent or luck? Talent or luck? This has been well studied in the public market investing by the consultants and what have you, and all the statistics and analytics that you can apply to a money manager, which I've been through with a fine-tooth comb. The point being is that, this search for data is an important one, but it's also the most rudimentary step, because the people that are doing the searching need to actually know what they're looking for to find the information and then actually be able to make a decision without looking around the room and saying who else is in the deal and who else is on the cap table. I mean, I've managed money in public markets, and we did our own securities research. We had access to data. We knew what we were looking for. I never had to meet the management, and I certainly didn't give a rat's rear end who else was buying Intel if we were buying it. And yet those are the signals and the impact on startup funding. And that's where, again, we have this perpetual inefficiency and lack of professionalism in how we fund innovation. So.
Well, that's a great segue, Joe. By the way, the comment on the data and the 4 data points is fascinating to me because I know it's a hot, trendy topic, but I like to look at new technology, or in this case, not at all new, 60-year-old technology like AI. When it becomes hot in my space, I like to actually get involved with it personally. Like I like to, when crypto was coming up, I got into mining, not because I was interested in mining. I wanted to learn more about it. And I started, really digging in that way. And now I've been building out AI servers just to try and learn more. And it's fascinating when you talk about data and you pump more data into training models, and it doesn't really matter what you're trying to do. More isn't better. AI is no different than a manager here. Like it's the quality of the data, and after you get past a certain amount of training data, it degrades. So you think it'd get better, but it doesn't actually work that way. There is a sweet spot there. I do want to, I think where I want to kick off is, let's start with one thing I know you and I have talked about before, Joe. We agree. I think we agree about it. It's been a while since we talked, but a lot of VCs with startups over the last 10 years, 10 plus years, were saying, and I think you even put in the note, Bonnie, as we were prepping for this, is put everything into scale. If you guys are making profit, if you have profit, if you've got a startup and you have profit, you're doing it wrong. You should be pouring it back into scale. I know why they say this. Okay. So the first reason is that when you think about a VC, they're kind of binary. It's a pass fail deal. They're looking for, they're hunting unicorns. By the way, let's stop for a moment and talk about how stupid that is. Okay. I launched 14 startups. I had 9 exits. Okay. I had 5 failures. I would have told you all 14 of those businesses at some point were going to be a unicorn. Otherwise, why the hell would I be doing it? I thought they were great businesses. Now, in fairness, I had a couple that I knew I was going to flip pretty quick. So maybe not all of them, but I thought many of them that failed were going to be unicorns. And I was in the best possible position to know. So how in the hell is a VC going to come and look at a deal and pick a unicorn? It's a fool's errand. So that's the first problem. But that's really the way that, when you look at where returns come in funds, so much of it is weighted for most funds, not my fund. I doubt the way Joe invests, but in most situations, they're using that 1/3, 1/3, 1/3 rule. 1/3 are going to fail, 1/3 are going to be flat, 1/3 are going to be unicorns, and all the yield comes in the top third, right? So if all you're hunting is that, then that's pretty good advice. Not for the company, but for your investment, that's pretty good advice. So that's the first challenge. Second challenge is most of these, when you get right down to it, most VCs, and they, again, I think Joe was kind of touching on this, they either haven't run a startup before, didn't launch anything, maybe we're part of a team. By the way, not the same. Not the same. Being in the chair is different than being on the team. Sorry. And they probably, if they did it once, maybe twice, but probably just once, if at all. That doesn't degrade the success they may have had necessarily, but it also doesn't give you a whole lot of proof for repeatability. And then the bigger problem I have is that so many of them have never even been through. Everybody on this call, I'm looking around this call and I'm like, everybody here has been through multiple downturns. The vast majority of the VCs who are actually interfacing with the startups, I'm not talking about, Tim Draper's a smart ass guy. He's a great guy. He talks to a lot of startups himself personally. But when you look at most VCs, you're not dealing with Tim Draper. You're dealing with somebody who's actually never seen anything but an up market. They have no concept of 2001. Yeah, or let alone, that would have been horrible, obviously, but they don't even know 2008. They haven't seen anything, right? So when they're giving you this advice, they really don't have perspective on how insanely difficult it is just to survive as a startup, right? So many teams we saw in 2020 that did not have runway, that team, had gotten this advice and were pouring everything back into scale. They're not here right now. The teams that survived were teams that realized that the best day I ever had in every startup I ever had, and again, I know this will go contrary to a lot of you, but there's a lot of good reasons for this. The best day I ever had was the day I got to break even. I didn't need anybody. I had control of my destiny. I also own my cap table. And I'm going to tell you, I've got founders in my portfolio who are going to exit, who have or are going to exit at 100 million that will make as much money as teams I have in my portfolio that are going to exit at 500 to $1 billion. it's because they didn't need to go raise all those rounds, and because they didn't throw everything they had into. You don't have to build $1 billion company to make an insanely good return as a founder. So some of this is a discrepancy between what I want and what, you as founders. And again, I think like a founder. So anyways, Joe, I don't know if you have any additional thoughts on that, but that's something I hear all the time.
Well, again, I've studied and observed from a front row seat the venture industry through three generations of VCs, right? The 90s, and our clients were some of the old guard from the 80s. So when I stepped into that firm in 90, and I saw after the internet commercialized, you had a radical change in the profile of who, because before the internet commercialized, all the hotshot MBAs were going off to consulting or investment banking. They weren't becoming VCs. Sure. Then the internet commercializes. Now they're the smartest guys in the room decide to call themselves VCs. And you could just see it. You could see the morphing of the incentives and the DNA for that sort of throw money at it because we're the smartest guys in the room. And like I said, I watched it, and it really distorted the very process of how we fund innovation. And it created incentives and reward system and a feedback loop that was that we're still living through today. And it's what drives these bubbles. And so, if you want to fix something, or if you want to define your outcome, you have to define a system where you're aligning incentives and rewards properly. And there's, as Glenn was saying, we have almost a contradictory structure. What VCs want is, yes, they want to, I call it financial foie gras. They're force feeding the entrepreneurs with money to scale quickly because they want a quick up round to have a quick markup so they can go raise their next fund. Mm-hmm. That is the principal incentive for this financial foie gras. And then the very nature of it is the fact that there's no professional, they don't understand risk management, portfolio construction. The importance of managing the number one risk in this asset class is timing risk. That is the number one risk to manage. And that means you need to invest over multiple time periods. You don't just force feed a whole bunch of money in one transaction and then expect them to blitz scale so you can get an up round to go raise your next fund. That's not the optimal way to invest. So you're literally sacrificing your fund one LP's money with that financial foie gras so you can get an up round so you can go raise another bigger fund with a new batch of LPs. So there's so many conflicts in the venture industry. And again, we're just living with these consequences. The entrepreneurs are the heroes. The entrepreneurs are the heroes in the system. And yet we've got an incentive system and a structure that actually elevates the worst behavior on the wrong side of the transaction, the VCs.
Yeah, you nailed that. That bit is so underreported too, the pushing to raise. And I didn't know that when I formed a fund, because I wasn't thinking about Fund 2 when I launched Fund 1. I wasn't thinking about Fund 3 and Fund 4. I didn't care about it at the time. I wasn't doing it for that. And so much of, if you're an entrepreneur and they're pushing you to raise money, you got to look at that and think they want to mark you up on the book. Your markup on the book drives their, juices their performance. And look, I'm in this industry, right? I'm not going to say I'm completely removed from some of these same biases, right? I like seeing my book go up too. I don't need it, but I like seeing it, and so do my LPs. And I don't get a lot of calls when my book goes down in favor of it, right? So Joe mentioned incentives, but we're driven by that. So understand when you're being pushed to do a bigger round. And by the way, Joe, this is part of the problem we had with what I call the tourist or hobbyist investors.
Yep.
And I'm not going to name names, but people on this call probably know these are monster investors who came in and offered many of our teams, probably many of your investments, ridiculous valuations to raise way more money than they ever should have raised. And some of those teams are in real serious trouble right now for a lot of reasons. Screws up the cap table. They don't know what to do with the money. You need to make a lot of small mistakes before you make the big ones.
Well, and that's true from an investment perspective. If you look at the research,
so true.
You do need to diversify. And also the most important piece of research that is not adopted yet, and our platform does. So I'm sort of pitching my own book here, but I'm not trying to. It is based on our platform was designed based on the research. is the most important thing an investor can do is deploy capital, maintain diversification, but deploy capital over multiple time periods, called dollar cost averaging, to manage timing risk, systematic risk. But the most important thing in that dollar cost averaging or the multiple staged capital deployment is how much you invest at the early rounds, how much you invest at your follow-on, and how much you invest at the next one after that. There's two optimization models. One's called the Kelly criterion, one's called the multi-arm bandit game theoretical construct. Both of them essentially come out of the optimization in poker betting, because the economics of poker is very similar to venture. If you make a bad bet, you lose all your money. Invest in a startup that fails, you lose all your money. So how can you deploy capital in a world of imperfect information so you can optimize on the total return of your total capital deployed? And you make a series of bets. And it's essentially both the necessity to have more dry powder for your follow-on bets than you put on the table in your table stakes. And then how much, again, from a statistical standpoint, how much should you put in a seed round portfolio so you can start gathering information and then invest more in the better deals that are certain as the cream starts rising. And then as the cream continues to rise, have the majority of your money ready to go. So think seed A and B round. That's the most important thing investors can do. And yet the incentive system, the pitch fest industrial complex, it absolutely is structured to incentivize tourist investors, whether you're an angel or a VC, it doesn't matter. It's the behavior that defines it, to write the big check early. Because they all get caught up in their limbic brain and FOMO and who else is in the deal and the optics and everything else. And they call themselves a high conviction VC. They have an under-diversified portfolio. They spend most of their money, and the first time they write a check for a startup, have very little dry powder to support their better deals. That's the majority of, and that's who entrepreneurs have to pitch for money. It's people that are doing it wrong. And that really is the equation that needs to be fixed, is a better way to deploy capital so that both the LPs have a higher confidence level for actually alpha. And then, but equally as important, that stage capital deployment is in the entrepreneurs community's best interest, because you're effectively solving for that funding chasm. If you've got investors that are holding back the majority of their money for the A and B rounds, now for those entrepreneurs that are executing well, you've got investors queued up waiting to write that check versus having to almost start the fundraising process over again for your A or B rounds. And so for both parties, it's the right way to invest benefits both parties. And just think if entrepreneurs could spend 70% less time chasing money and apply that to building their businesses, what would those equations, that third, I think that equation would change. If we just made the process more sophisticated, more efficient.
We're seeing a ton of that holdback for, it's not even necessarily, I wouldn't even say it's necessarily holdback for, A, B, C later rounds now, but we're seeing a lot of the bigger funds holding capital. It's protective right now. It's a little bit different mentality. Like they need to look active, but they're not actually doing new deals.
See, and that's the funny thing is a lot of that behavior is licking their own wounds.
Yeah.
When in fact, and the reason they're licking their wounds is because they spent too much money 2 years ago or a year and a half ago or whatever, right? During the run-up. So
or didn't look at the data.
They didn't care about data. When in fact, there's a great adage from Warren Buffett is where I heard it from. I'm not sure he originated it. I doubt it. But he said, be fearful when others are greedy and greedy when others are fearful. Now's a great time to be spending money in startups. Jesus Christ.
I will give some optimism though. I mentioned I just came from that big conference, but bunch of family offices. So I was mentioning before others joined the call, I was at a big stealth family office conference down at Stanford last week. And the optimism is actually really strong. It's not about the economy, don't get me wrong, but about investing in alternatives, deploying capital. When you think about where funds get their money, they all get their money from foundations, endowments, families. Like they don't actually have money. They get it from other people. And those people who are in the room are actually very excited because of what Joe just said. They follow that methodology, and they're like, they don't know that this is the bottom, but they're not waiting for the very bottom. They know it's low enough.
It's low enough.
Yeah.
It's low enough. When the tourists leave and the FOMO crowd leaves, which again, I've watched this through 3 generations of VCs, and it's largely at about, I'm guessing halfway through a cycle, about 60% of the decisions, and then it becomes higher than that, are FOMO driven. There's very little real disciplined investment decision making that goes on.
Yeah, it's all chasing.
It's chasing. It's exactly right. They're chasing. And that's the money that goes away. And so you've got plenty of time to call those cycles and just sit back and watch the idiots do what they're doing. One of my board members, it runs the venture fund of funds practice for GCM Grosvenor, big consulting firm out of Chicago that handles, sovereign wealth funds and Taft-Hartley pension plans, that sort of stuff. And he runs their venture fund of funds. And he stopped taking engagements 2.5 years ago. Sequoia came to him and he said no. He was the allocator, and he said no. He says, I don't want to put money in this crap. Right. And so
the pattern matching crowd doesn't match that one pattern very well.
Yeah. And we need to build a system that actually incentivizes and rewards good investment behavior, because it will lower the cost of capital for entrepreneurs. It'll make it more efficient for them to access capital across multiple funding rounds if you're executing, which is all entrepreneurs need. And that will have a multiplier effect on that sort of batting average inside the venture portfolios. The data is clear on this. But it's not a profession.
Bonnie, if you'll allow me, let me do a quick check, just a couple checklists, just so we can kind of review a couple things.
Yeah, and I want to hear about the dumb things that investors tell founders, and I think the founders in this room need to hear that too.
Well, yeah, some of them come up. They're just kind of buried in there. So, like, let's start with one of my personal favorites is be very careful about trusting people like me. Not because we're dishonest, not because we're bad people. We want to help usually, but be careful of trusting experts when you sit down with them. We want to provide value, but we probably have 15, 20 minutes, maybe an hour. Sometimes the incentives, as Joe said, people never do. This is true for your employees, your customers, your investors, everybody. They never do what you ask them to do, what you want them to do, what you hope they'll do. They only do what they're incented to do. This is 100% true. So when you're building your company, particularly when you're building culture and employees, you need to remember that. But so if you meet with people like me or Joe, okay, people in the field, people who are, whether it be venture, angel, even just somebody who's exited a company and is meeting with you as a potential advisor, be very suspect, right, about what they say. Listen, take it in, consume it. But you've had hundreds or thousands of hours, they've had minutes. Just bear that in mind. Second thing, when people tell you to raise, understand, or pretty much anything, but particularly when they tell you to raise additional capital, understand that their incentives, as Joe said, are different. So there's a mismatch between what you maybe need to do as a founder or should do as a founder and what they need to do to mark up their book. So that's something that I would be very, very careful about. Understand many of these people have never been through a recession. So it's not in there, and nor are they bothered by a recession. It's not going to hurt them. Particularly, their fund might do well, but they'll land just fine. Your business will be out of business if you follow some of the advice you get. So you have to be I think you have to be more defensive in a startup than people give than what they tell you, right? You think that you're building just for scale and growth and you can't raise. There are lots of ways to make a really good return on a startup. You don't have to build $1 billion company, right? That's another big myth that's there.
Yes.
So there's been a number of things that we've touched on already, but here's one I wish somebody had told me, Bonnie, and I figured it out, to be honest with you. I figured it out. When I first started, we didn't have, Joe was talking about 93 and kind of the evolution of Sand Hill Road. So I got to the Valley in 95. You couldn't just go find money everywhere, right? It wasn't like it was coming up, right? But so my first company, I raised $250,000. And the problem was at the time, a server cost about $200,000. You had to have cooling systems. You had to have, now this is probably something I shouldn't admit, but when I walked when I would walk partners through our building, we had one functioning server, a whole bunch of face plates that I had my team wire up blinking lights behind a glass wall with a locked door. That was our server room. So we had one functioning server, but it looked like we had a whole room of machines. I shouldn't admit that, but we were able to do what we needed to do, and we couldn't get capital at that time. So that, obviously the world has evolved a little bit in terms of where we get capital. But if I'd worked with VCs back then, I probably would have figured it out. And a few years later I did, that VCs themselves are reporting their numbers to their investors, right? So as founders, if you get any angels, institutional investors, VCs, corporate VCs, find out if they put out any kind of, like, even angels do this. Find out if they put out an update or newsletter to their people, right? To their syndicate or to their LPs if they're a fund. Find out when they report, what they report, how they report, what the tone of that is, what metrics they like to report. Find that out and be sure that you align your updates with that. Why? Because the squeaky wheel gets the grease, guys. And I want to talk to my investors about what's going on in my portfolio. Again, this is kind of contrary to what I was saying about not juicing results, but again, I'm human, incentive, reward. So I'm getting feedback from my LPs when I send out updates, and I want those updates to be timely, and I want them to be generally good. But if it's bad news, I'm going to put it in there as well. But I need information. I need data to put in there. So one of the things you guys can do is absolutely figure out when your sources are reporting back to their sources and get them the information they can include and get it in a format they can consume. Don't send them a 4-page letter. Don't send them put a too long, didn't read bullet at the top. Put a bunch of just bullets of data. I'm going to tell you, most of us, even those that don't like data, Joe, still like to punch metrics in their newsletters, as opposed to, we met with this group and had a good meeting. None of that matters. And so it matters to us when we're building companies, but it doesn't matter to the people who are reporting upstream. So do those things. Think about that. And that's one of the things, another thing I wish I'd known when I got going. I think too many 280 or teams we have in our portfolio, probably only half of them even send me quarterly updates. And we demand them. It just doesn't make a damn bit of difference. And when we send out a newsletter, and Joe, I don't know if this is true for you or for other groups, but when we send out a newsletter, $500,000 to $1 million, we usually have 25 teams in there. About 12 of them are raising. $500,000 to $1 million gets deployed by people who receive that newsletter into those teams without me having anything to do with it.
Oh yeah.
So it matters.
Well, that's the part of the platform we built. As I was examining how I manage money, I never met with the managements of the public companies, and I certainly didn't talk to Wall Street analysts. They were conflicted in their incentives and rewards.
That's a great point too.
Oh, absolutely. That was well sorted out back in the 90s, how conflicted Wall Street research is. The process of why was I able to manage money as efficiently as we did from a computer, never having to do earnings calculations ourselves. I had good data, and we had research process that we deployed with a great deal of discipline, is because public companies have to report per the 33 Act. Then the Securities Act of 1933 literally says, in an act of risk management, they've established standardized reporting requirements if you want to be a publicly traded company. The legislation says in an act of risk management, and the SEC was formed to enforce it. The first thing we built is the first public company equivalent IR. Glenn, I need to show you what Angelspan actually does. We built the first public company equivalent IR because you need standardized reporting, period. It's an act of risk management. And there's a wonderful piece of research that came out and was covered in TechCrunch back in 2020. A university in Scotland, of all things, took a whole bunch of venture data and looked backwards on the performance of the portfolio companies, much like you're thinking. And what they found, and they did a great deal of statistical analysis, the single greatest due diligence criteria, de-risking criteria for an investor is the entrepreneur properly and voluntarily transparent? It's the single best de-risking due diligence question or observation you can make. Are they properly and voluntarily? And the research site defines what they meant by that and what they found in their studies. A gratuitous marketing email, hey, everything's great. No, that's not proper. And also entrepreneurs that only communicate around funding rounds, bad signal. That's powerful information, that signal, because it's a window into the psyche of the CEO and how they're running the business and how they're managing their teams and how they're going to be authentic in selling their product to the marketplace. So it's a singular data point that is unbelievably powerful. It's simply the evidence of proper and voluntary transparency for this exact point. And what we learned back when we were launching Angelspan, and we got some early use cases, and literally we had, when the startups would hire us and they'd put their first update out and they'd get investment without even pitching, because the people in their stakeholder list were glad to finally see communication, right?
Yeah, that transparency.
So there's lots of those use cases, to your point. But what we found is when we took these use cases to VCs, family offices, angel groups, and they would say, hey, we don't hear from you. Their existing portfolio companies. The entrepreneurs come with, yeah, okay. And they patted their investors on the head and didn't adopt Angelspan, even though these investors told them to. So this is one of the key things investors need to understand, is they need to build in this expectation. It's incentive and reward. If you want my attention, much less my money, I want to see transparency before you start the due diligence process, before you let your brain get excited about the idea, before you start losing objectivity, buying the future or getting excited about the future. You've got to de-risk it right up front. It's the single most important thing, because again, you want to improve the batting average of your portfolio. Only invest in startups that are voluntarily transparent. You would crush it. I don't care what the thesis says, because you'd have fewer
it correlates. It correlates with our numbers in terms of performance. If we look at the teams that report,
it always does. And this does not have an incentive to adopt.
Sometimes
they do not have an incentive, because they like to make it very black box mystery. And I, who else is the deal? And I know quality of flow because I'm the smartest guy in the room or smartest gal in the room. No, if you simply invested off of a transparency thesis, you'd crush it for your investors. Wouldn't make you look like the smartest person in the room, but you'd crush it for your LPs. And you probably couldn't charge 2%, because you don't need a whole due diligence team that probably doesn't do a lot of real due diligence anyway.
Yeah.
Bunch of junior interns that are out there running around collecting data, and you're calling that due diligence, for Christ's sakes. I mean, it's a joke. When I compare it to how we manage money in the public markets, the venture industry is a joke. And the historical returns of the asset class reflect that. The data is clear.
Now, there may be some correlation too. I'm not sure. I haven't dug into this, Joe, but it may be a combination of both sides of that. One, teams that report, they've got better, kind of better protocols, better habits, better everything else. The flip side of the end, and also too, teams that report are getting more lift, right? So like when teams that are actually engaging with their advisors, with their investors, are actually getting access to those networks. So it probably works both directions. I haven't spent any particular time.
We've got a report on that. We actually went through a program here at UT called Texas Venture Labs, and they gave us a team of grad students to do a free project for us, basically. And we had them do a national survey, proper primary research survey, interviewing VCs and active investors around the country. Collectively, their self-reporting numbers of startups they had interacted with was over 7,600. Again, all respond to a formal survey. Around this issue of transparency, the correlation between transparency and success. And as they did their survey, what came out is exactly your point. It's both a corollary relationship. They're doing better, so they got better stuff to report, so they do report. But there's causality, your second point. The feedback loop and the information and the value add helps them avoid the big mistakes and put out the fires as they're just small before they become roaring. So it's both causality and correlation. But at the end of the day, it's still the same conclusion. Don't invest in a startup that's not properly transparent. Well, don't start down the due diligence path unless they are.
Let me toss something else in there too, because I think that a lot of founders think it's a pain in the ass, right? I do an update for our LPs, and I think, and I know it's long, but in our particular case, I know my LPs, I know who they are, I know what they like, and I know that most of them want the level of detail I go into. But I write a 15-page update, okay? And it's got 25 teams, it's got a lot of data on each team. It's data laden, let's put it that way. But that's not for everybody else, guys. That's as much for me. I've been asked many, many times to outsource this to one of our associates to an intern even. No way. Okay. This is the same reason every entrepreneur on this call ought to be doing updates. These are for you. You have to think about part of it is distilling your information down in consumable packet, right? And that's an important exercise to go through on an ongoing basis. And part of it is actually being honest with yourself. Like you can spend all the hell you want, but at some point you have to, when you're working internally, you need to be brutally honest. So this is that balancing act between those two things. Same reason when you build a business, here's another piece of shitty advice you'll get from VCs. I've seen this and I think I've mentioned it to you, Bonnie, before. I have so many VCs that have talked to my founders and said, you don't need a business plan, just do a deck. Well, no, deck is important. Don't get me wrong. There are a lot of really there's smart people like Bonnie on this call that'll help you with the deck for that matter. And it's critical because it's that distilling things down. But no, you need a business plan. It isn't for them. It's for you. Like if you haven't gone through that process, you honestly haven't thought about this near enough. You shouldn't be asking anybody for money. That's irresponsible. You shouldn't be wasting your own time. That's irresponsible. That's the most valuable thing you've got. I know that's, trite, but it's absolutely, as I get older, I totally realize that's true. At 29, I didn't get it, but I get it now. So do a business plan for sure. That's like the same kind of exercise. The updates that you're sending to investors, partners, hopefully even your own team, because if you're being really, that'll really force you to be honest. If you're sending those updates out, that's for you as much as it is for me, by the way.
One of the attendees here, Tino, is on this call, and he was talking about the success he had at that event. Well, Tino's a client of ours, and through our reporting, we actually track their operating performance through a framework that allows us to do so. So we've created actually Wall Street quality analytics on the performance of our clients, standardized performance analytics. And Tino is absolutely one of our best clients, and I could show you with data, not about his business, not that I like Tino. I've got data to show that how he stacks up against our 80-some clients, and it's based on performance. And so his success in the pitching, his success in the marketplace is very much correlation to a CEO that is properly transparent. So these dynamics are just so blatantly obvious. And thankfully, even the SEC is finally getting their act together and starting to instill greater transparency requirements from Reg D offerings. That includes hedge funds and venture funds and private offerings from individual companies. They're actually baking in more transparency expectations because it's a de-risking outcome.
They do have to be careful with that, though. I mean, I don't want to waste a lot of time today. I'd love to get on a call with you and Bonnie separately and talk about that. They have to be careful because it could really impact smaller funds more heavily, like early stage funds that are sub 15 million could get adversely impacted if they go too far. So it's going to be interesting to see how they build that. You don't want to drive that out of the marketplace. You don't want to drive up cost for those groups necessarily.
Well, you and I could have a debate on that.
Well, you have to have, maybe you drive the funds out. You still have to have the capital in the ecosystem. So maybe the argument is it'd still be there. It just wouldn't be in that format. But
it wouldn't be in dumb hands that have no corporate governance.
That could be a reasonable argument. And you could win me over with that, Joe, potentially. Here's another one, Bonnie. It's not so much in the category of what I wish was somebody had told me, but here's one that I wish somebody would tell founders now. Okay. It's more, and I think I'm really curious because we got a lot of more experienced founders and people like myself and Joe and you on the call. So I'm kind of curious what other angles people see, but what's old is new again. So what worked in 2001 suddenly works again to raise money, right? So I was talking to some founders, and I think I've talked to Sam about this a while ago, but it was about 6 months ago I saw this happening. I was talking to a founder. They're trying to herd the cats. They couldn't get anybody across the goal line. They couldn't figure out, all these people that were theoretically interested. They just couldn't get the deal done. And so I was talking to them about structure, and I was like, well, why don't you use an escrow? And they're like, how do you do that? I'm like, what do you mean? How do you do that? That's like the only way we used to raise money. It's a matter of trust, right? So you know, you probably have corporate counsel if you're a startup. I certainly hope you've got somebody advising you legally. They have an escrow account. They won't charge you anything or shouldn't charge you anything, or if they do, it's going to be nominal, nothing. But they have an escrow account they can receive capital into, and you can set a minimum threshold. So back in the early mid 2000s, when things were crap and nobody wanted to be the only money, because here's the risk: you give somebody a check, you give them, let's say you're an angel or a individual investing, and you give somebody $100,000 and they needed 500,000 or let's say $1 million to be able to even execute on the plan. If you just give them $100,000, no escrow, no minimum requirement, you're screwed. Like, they'll spend it and you're done. So if you sit around and or if you're trying to raise and you got a lot of investors sitting around not giving you capital, well, trust me, that's one of the things probably going through their head. Set up an escrow account with a minimum close, then move them all to the escrow. None of them are at risk. It's a de-risking strategy. There are others, but that's the only way we raise capital until I got to about probably 2007. I don't think I ever had a deal that didn't have escrow until about 2007. And then I didn't see any for years because everybody was just freaking throwing money away, which is really what that is in a way. So I don't know if there's other strategies.
You're so old school.
I mean, I don't like risk, right? So I think look back at what worked in those tough markets, folks, and try them now. They'll work again. They worked before for a reason. I don't know. I was trying to think of other ones this morning as I was thinking about this. Obviously, cash flow break even was a big deal too. But I was curious if there were other things that you guys saw in the funding markets, or if I'm not sure off the top of my head if there's anything anybody on the call might have that worked for them in the past. But those are the types of things. Look back at the stuff we were doing back in the day.
Yeah.
I did want to ask if anybody has a question, just in case at this point. Does anybody have a question?
That's good idea, Bonnie.
Ian?
Yeah, I had a question for Glenn because you mentioned this poker betting analogy.
Oh, right, Joe. That was Joe.
I was interested in like how that matches up with the data-driven approach. I mean, so there's still a kind of a random, in a sense, a kind of a random element that you're introducing apart from the data. So how do the two fit together?
I think that was me.
Yes.
If you look at the economics of not just the multi-arm bandit or the Kelly criterion, which defines how much you should invest at the seed A and B rounds, but the economics again of a venture transaction, and also the logic, because if you need to invest optimally to manage timing risk across multiple rounds, starting at the seed, because by the time there's a B deal that's actually a worthy hot deal, where you have enough time and evidence and traction to validate it's a hot deal, not just optics on who else is in the deal making it a hot deal. Those become crowded trades. B round and beyond that have evidence of traction, boy, it's hard to get on those cap tables unless you have pro rata rights. So that's why you see what's called scout and opportunity funds to get the pro rata rights to exercise over time. Now, so in that context of investing in multiple rounds, how much? Well, the fact is, at the seed round, I don't give a shit who you are. You do not know what a good deal is, because that implies you can predict the future. Just like in poker, you can't predict the future of the next series of cards. So you have to gather information and minimize your early bets to start getting an information advantage. And so that's the fundamental parallels between poker, the logic of poker, and the facts about venture investing is nobody knows what a good deal is at the seed round. I don't give a shit who you are, because that implies you can predict the future. So you have to embrace that from the get-go and say, if I don't know what the future is going to hold, how do I optimize on placing capital to optimize my return in an unknowable future? That's the analogy with poker as well, because you invest as you get information, as your seed stage companies actually start performing, the teams gel, they execute, whatever they're working on actually is getting some degree of traction in the marketplace, because the marketplace changes. We could have World War III. We could have a pandemic. There's exogenous events that affect timing. There's execution issues, the internal issues that affect timing. And thus, the earliest the stage, the greatest amount of timing risk. So you put your least amount of capital there and have the most diversification at the seed round.
Right.
right? To manage transaction risk. More due diligence does not de-risk, only diversification. It's well known. It's the only free lunch in investing is diversification.
Yeah, especially
Right.
at the seed stage in particular.
Well, you shouldn't abandon diversification at the A or B round either.
Okay.
Because there's still risk.
Right.
Yeah, and we just went through a pandemic that could prove the folly of being leveraged in one vertical.
Yeah.
Like, I'm not
Yeah.
saying, look, if you got core expertise, I get why you do it, but if you're just focused on yield, it doesn't make a lot of sense.
It's just the sheer fact is nobody can predict the future. The interesting dynamic psychologically is investing in startups is about trying to place bets about the future and maybe even have an impact on the future, right? Help shape it. And that's the way I described it with when I was managing the family office was investing in the public markets for me was like backing into the future by analyzing the past. Investing in startups is turning around and saying, okay, where do we want to place your bets about and help even manifest a future? It's a lot more interesting, which gets your limbic brain involved, which means you're abandoning your critical thinking and risk management. So it's that delicate balancing act you have to manage. And the best way to do that is through the structure of your venture and your capital deployment, diversification and stage capital deployment, to put up guardrails to protect you from yourself and the other external influences that, again, impact the limbic brain and bad decision models.
I don't know if it's the right place for it, Joe, but it cracks me up every day practically, but certainly every week I'm approached by one of our founders who's got a good business, but has heard some story about some founder who's raised some stupid amount of money, some crazy high amount of money, and they're trying to rationally understand how that crappy business raised this crazy amount of money, and what are they doing wrong? And it's like, they're going to be, there's just so many poor deployments out there, and some good. Look, some founders raise a lot of money because they should, but there's loads of them out there that are creating bad example.
It's exactly right. And that's the perverse incentives and rewards and feedback loop that has been, the curse and the cancer on how we fund startups, because the model hasn't changed. And this was written by Tom Nicholas, teaches entrepreneurship at Harvard Business School right now. He wrote the book VC in American History. It's a great history book on venture capital. And on page 311, he said, and this book came out in 2018, he said, it's ironic that the industry that purports to fund innovation hasn't innovated.
That's true.
The venture model is largely the same as the first fund that was launched in 1959, and the decision-making process is the same. Oh my God. How ironic.
So I know that Joseph's had his hand up. Joseph, you want to
Yeah.
ask first?
First of all, I really appreciate the poker analogy. I totally get that. Very much in line with how I manage my book. But my question was around artificial intelligence. Where are you guys deploying capital in that space?
So I'll kick it off, Joe. So it's not, from our perspective, it's improved, but not new. How about that? Right. So, it's funny. I had a team approach me the other day saying I don't want to offend anybody. We're the first company in X industry using artificial intelligence. Unfortunately, I ran a company in 2002 that did the exact same thing and was the market leader in the world. And how do they think we did it? Like it was, I can't, without telling you what it is, but it was matching patterns, right? Which is half of what the world is doing in any industry at all times. So for 60 years, we've been doing artificial intelligence. What's happened is the accessibility of it has changed dramatically. And the number of companies without tremendous core back-end knowledge that'll be able to take full advantage of that is going to increase dramatically. We're already heavily leveraged in it, Joe. You and I have talked before. So we're heavily leveraged. About 40% of our portfolio, Sam's on this call on the video side, video management, but about 40% of our portfolio, big part of our thesis, my thesis as a founder was always don't invent fire. Take it to a village that hasn't seen it before. That was a big part of what I did. And so what I mean by that is not to be, I still want to be disruptive and innovative, but my goal is to take innovative technologies into industries that have yet to be innovated to the degree they should be. It's a much easier exit strategy. It's a much easier adoption strategy. There's a lot more money there. Sales cycles are shorter. So we're about 40% in our portfolio, but not directly in AI. I guess the parallel I would give is, people talk about the gold rush and the people who made money were selling picks and shovels. We focus on core businesses, and AI is a component of the core business. Or a component of the business. It's not the core business. And I think that that's probably going to continue to be our approach, kind of going to what Joe was saying earlier. It allows us to diversify and spread our bets around, make small bets, and then as we see evolution, to make larger bets on those deals. And the other thing I would say, I think it's a great place to put money, don't get me wrong, but there are inflated valuations, and we're clearly a value player. That doesn't mean that I'm driving founders down on value. That means I'm looking for deals early that haven't been bloated by a tourist investor, and that are getting a reasonable valuation relative to their metrics. That's hard to do in core AI right now. And you can argue the upside's greater. I'll reserve comment and wait and see what happens in 2 years. I'm not saying you're wrong, or anybody, not whoever holds that position. I'm not saying they're wrong. It's just not my thesis.
And I go back again. From the lens of a portfolio manager, I've watched these hype cycles, the Gartner hype cycle. You've got to put that overlay. And if you've been around long enough, you saw all the rationalization of the internet's going to change everything, and you had all this hype, and you had all these stupid business models because the internet was the end. No, the internet was a tool. Technology is just a tool. That's all it is. And AI is just a tool. Yeah, it's been around a lot longer. Glenn said it perfectly. It's just more readily available. But I'm not a technologist. I'm a finance nerd, and I try and find really smart people and listen to them. And I heard a really smart guy say, it's hype, almost exactly what, we're in the Gartner hype cycle. Is it a legitimate tool? Yeah, it's been around a long time. Okay, so it's going to be more available. Well, that's good news and bad news. I saw the whole, when we had online trading. Wow, online trading was the coolest thing. You had the internet, and you had online trading. What did that do? It blew up a lot of people's balance sheets, because idiots that now think that because they can trade online, they know how to invest. And they lost boatloads of money in the process. So again, you've got to be very, very careful. And unfortunately, if you look at the history of Silicon Valley, Regis McKenna is probably the devil, in my opinion. He was the first marketing and PR guy that the venture industry embraced, because he created the hype around fill in the blank. And that, before Regis McKenna, you didn't have the hype cycle around new technologies. The people were more measured. They were more, many of the VCs were engineers. They say, well, let's see what happens. We've got a lot of testing to do before we even get excited about this new technology. But then Regis McKenna shows up and starts hyping it, and now that's part of the unfortunate playbook. So,
and there's, by the way, there's just a quick comment too, Joe. I'm sure you're already looking at it, but just, again, given that because you're a very active investor as well, but I think computing power, quantum computing, energy, these are some other issues that revolve around AI that are going to be interesting. I mean, the direction AI is going is a lot more consumption, a lot more power, a lot more need. So there's going to be investing opportunities there. There's also going to be some challenges related to how this stuff gets rolled out. It is very intensive, but where we're going with it.
Between Bitcoin mining and AI, or do we have enough electricity and processors? There's some real laws of physics here that are presenting boundaries. If you do the math, if you start doing some logical extension, there's some boundaries. And so there's some things that have to change.
I was joking at the beginning of this. I don't know how many people were on, but like, as new technologies come out, I deploy them. So when crypto came, I've been in crypto for a long time, about a decade. But when mining started becoming more of a thing, and I was trying to learn more about cryptocurrency, I got into it casually. I built a miner. Then I had 12 cards. Then I had 96 cards in my garage. And then my family has property with mineral rights and wells. And so we have flare gas coming off oil wells. And I was creating mining colonies off of the flare gas. So, I mean, I went from being a guy who was intrigued by it to a guy who was running a company around it effectively. And the same thing is happening with AI. So I'm getting into AI. I can see the consumption because I'm building an AI a series of them right now to try and solve some problems of my own. And by the way, it's not so, it's not the end all be all, just for those who are, I mean, it's an amazing tool. And even with the accessibility it's got, but I'll reserve comment on that. We'll talk about it in 2 years and see what happens.
You know, it's funny because when every technology was going to disintermediate everything and blah blah blah, put all these people out of work. Now they're saying the same thing about AI. You know, only the words have been changed to deceive the clueless. It's almost a case of that. I'm sorry, this one to interject.
Yeah, the jobs it'll be fascinating if it does do that, body, because the jobs it'll take off the table are going to be maybe a little bit different. You're still going to have to carry a toilet. If you're a plumber, you're still going to have a job carrying a toilet into a bathroom and installing it. That's not going to be one of the early jobs.
AI will eliminate a lot of non-value add service jobs.
A lot of I came out of law. I wouldn't want to be. I would be very careful.
Yeah.
Actually, you know, it's funny. Pattern matching. AI is very good at pattern matching. You know what most VCs do? And in fairness, we built at Quake one of our differentiators, but not for ultimately selection, but for sourcing. We built an AI tool at the very beginning of Quake. It was a big part of our strategy, and it allowed us to scrape the internet, you know, to do a correlation between, or, you know, cross-check against Crunchbase, AngelList, all the list of new startups. We'd then look for traction, announcement of contracts, things like that. Then we'd look to quantify that with an upgrade score as to whether it'd been shared by the partner and so on. And then once we got to a certain point, we would reach out to the startup and say, apply to the program. And so there are applications for it that could be very, very valuable.
I agree. I couldn't agree more.
We have another question?
Yep, I couldn't agree more.
By the way, Bonnie, and
yes,
if I could reserve 5 minutes, I want. We've got so many founders. I'd love to run through some.
Sure.
Startup first principles at the very end if we got a chance. Just 5 minutes. That's all I need.
I think that's about what we have left, and I'm going to have you two back on again. So go ahead.
And I've got a hard stop at the top of the hour. I got another call. So yeah, go ahead, Glenn. You take the rest of the time.
Yeah. Okay. So just real quick, I do like 90 minutes with our founders about some of the things that I think you absolutely ought to do. I'm going to try and distill down some of the big points in 5 minutes. So first thing on funding, every startup founder has to do it. They get hung up on it. Just remember, don't celebrate it too much. You're not in the business of raising capital. If you are, you're in the wrong business. You could get paid for that, but that's not this. So be very careful about celebrating that, because it's very easy to become, it's like a drug and you can run with it. So be careful about that. Don't spend a lot of time worrying about the competition. Teams spend way too much time. This is probably a harsh way of saying it. You're far more likely to have your startup die of suicide than you are from murder. Like it's not what most of what your competition is doing is probably really dumb anyway. Like a lot of the things that you would pattern match and chase there are probably bad, you know, not on. Again, vast majority of startups fail. Why are you going to follow that? Right? It's generally a bad thing. Culture in a startup, huge deal, right? So it's going to happen regardless. We were talking earlier about incentives. You know, I don't have really time to go into that, but your culture is going to happen no matter what you do in your business. You can't ignore it. But the number one thing you can do is hire right. So hiring right is actually not about hiring right. It's about firing right. You're going to make so many bad hires. Put off hiring as long as you can. The people that you would get in your company at this stage are working somewhere else and they don't need you, right? That you have to build. That's terrible to say, but like when you're a seed stage startup or an early stage startup, people have options. The best people, you're going to grow into those best people. You're not there yet. You might have a great story, you might have great vision, but it's very, very hard to get those people. So put it off as long as you can. And then when you do it, go all in on it, but also be very, really prepared to fire quickly. So hire slow, fire fast. I know it sucks, but if you get the wrong people in your company, it's like stage 4 cancer in your company. You really will destroy your culture. Hire for attitude, not skill. That sounds so counterintuitive. You can train some skill, but you can't train out bad attitude, right? And so attitude is almost like the immune system inside of your company. You know, if you get good people in the company, they'll get rid of bad people. The other thing that goes with that, you have good people and a good vision. Vision's not a bullshit statement in your business plan. If you have a really strong vision, mission statement, and you have good people, you will attract like similar people with shared passionate view. And again, you'll create this immune system inside of the business. So do that. Let's see here. What else? Somebody said this years ago. It's not my idea, but I love it. And I'm just going to say it. So we only really, most of us, unless you believe in reincarnation, most of us only live once. And even those that believe in reincarnation, you're probably not going to get to do this again. So you're going to have a lot of time. I'm at that stage of my life. I got a lot of time to think about the businesses I built, the people I dealt with, how I dealt with them. You're writing a book. You're going to have a lot of time to think about these type chapters. Write a story that you can be proud of. And believe me, as crazy as hokey as that sounds, if you write a story you're going to be proud of, you'll do a lot better. Right? I have a lot of friends who wrote bullshit stories, and I kind of watched where they go. Okay, yeah, I'm going to cut there. I'll leave one last thing. Live a little bit like Warren Buffett. I do this every day. I could spend a lot of time on habits and other things. Just think about compound interest as you're building your startup. Spend, when you get to the end of your day and you're ready to quit, take the one hard thing you didn't want to do and do it. Put in 1/10 of 1%, put in 1/2 of 1% extra every day. Do it every single day. Your competition isn't doing that. It will make a difference. It'll make a huge difference. You will win. So just think about in everything you do, compound interest, instead of sitting down and watching that, Real Housewives or whatever it is that's on TV, sit down instead and read a book about business. Just take an extra 10 minutes. It's so stupid, but this is the stuff that winners do and losers don't. I mean, it's brutally true. Just is what it is. Run an extra lap. And if it was a sports analogy, which I played all the way into college, put in that extra time. That's it, Bonnie. It's not rocket science, but hopefully folks will do it.
No, thank you. I was taking notes. I was writing all that down. That was fantastic. Oh, I'm sorry we didn't have time. Something you wanted to add, Joe?
The only thing I would add to that is just yes. But philosophically, knowing what to do is not hard. Doing it is. And that's to Glenn's point, is that your competition probably isn't. And the other thing I would say is understand time and play the long game, because everything Glenn just talked about is largely your balance sheet assets of your business, your brand, your culture. These are all intangible assets and the most important assets you build. So.
Oh, one other quick thing, Bonnie. I saw somebody raise $2 million. I saw a founder raise $2 million in the room I was in last week with this. So one other piece of advice. A lot of deals are down pricing, right? So you got B rounds coming down into A coming down into seed. Prices are coming down and they're competing with you guys. So what do you do against that? You may not have as much traction. The problem is they're old and tired. They've been in the market for a while and they're having to reprice. Use that against them. So basically their upside is somewhat limited at this point. They've already shown it. They've already, to Joe and Joseph comment earlier, they've shown their hand, right? We kind of know what their upper potential is, and they've kind of faltered. So not only do we know what their upper potential is, they already stumbled at it. Your potential is untapped, unknown. So the risk is largely the same. This is an unfortunate reality. Even when you get into an A round, it ain't a whole lot better than a seed company from a risk perspective. It's better, but it ain't a whole lot better. And so basically the risk is still there. I would argue their risk is increased because they already had to down price. So they've actually increased and shown vulnerability. The upside in there and your upside is untapped. So if we're going to take equal bets on equal risk with more upside, that's your argument right now, guys. I watched a founder use that, because somebody came back at him and said, I can get this deal. And they're like, well, that deal's broken, and went through that argument. You can spin it a lot more eloquently than I did, but that worked.
Thank you so much. This was fantastic.
I do have hard stuff. I'm late for a call. Glenn, it's a pleasure. Always is fun.
Always fun, Joe.
Thank you. I got to run.
Great talking to you, buddy.
Oh, thank you. I don't know if you have time to stay or if anybody has any questions, Glenn.
Yeah, I'm fine. I'm good. I always carve out extra time for you, Bonnie.
Oh, thank you. I appreciate it. Anybody have any questions or anything they want to add or say? Joseph Chen, I know you have something to say. It was a very active investor, by the way.
Not today.
Oh, he's not. Shocking.
Actually, Glenn, I'd love to catch up in the next day or two if your schedule allows. I don't know if you have time later today or tomorrow, but
Yeah, we
give me a-
can try. I think you've got my link. You should have my link, Sam, but if not, I can resend it. But the challenge is with the holiday coming up, every founder is
course.
telling, my office hours are wide open, so everybody's
Okay, you know what? I kind of didn't know you had off.